I think we've got a little bit frothy. That means we're kind of ripe for a little bit of a pullback, but it doesn't mean to say that the bull market is over, not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough.
The collapse isn't coming.
You're watching
It's already started.
Silver News Daily.
Behind the
Subscribe for more.
scenes, the Federal Reserve is in full-blown panic mode, quietly preparing for what could be the biggest monetary reset in modern history. With the U.S. national debt exploding past $37 trillion and the government lurching from shutdown to shutdown, the system is fraying at the seams. And while most people are watching stocks and crypto, the real storm is brewing in the precious metals market, because gold is being repositioned and silver is about to detonate. A growing number of insiders are now pointing to a gold revaluation to $15,000 per ounce, not as speculation, but as necessity. And when that happens, silver won't just follow, it'll ignite. We're talking about a supply shortage so severe, a price move so violent, it could make 1980 and 2011 look like minor speed bumps. Physical silver is vanishing. Vaults are being drained, premiums are surging. And all of this is happening while mainstream investors sleepwalk into one of the most manipulated and explosive setups in market history. But here's the twist. This isn't just about precious metals anymore. It's about survival. The dollar's credibility is dying. The Fed can't stop printing, and the clock is ticking toward a point of no return. So why are so many analysts calling silver the ultimate play in the coming meltdown? What do they know that the public doesn't? Stick with me, because what you're about to hear will change the way you see money, markets, and silver forever.
Came out and said gold could reach $4,000 an ounce. And I looked at the price, it was $3,977. I thought, why do they wait until it's $23 away from the $4,000 mark to tell us it's going to reach $4,000? I mean, that's kind of an easy one. But I suppose they just want to say we predicted it. Of course, you and I and many of your viewers have been saying that gold could go up to 4,000 and beyond, and we've been saying it for years. I think it's gone faster than many people expected, and the whole world, and I get many messages about from people saying this, when's the pullback coming? I'm not in, I want to get in, but is there going to be a pullback, and at what price should I put my limit? And I think the reality here is a lot of people missed the boat or feel they missed the boat. And so every time there's a pullback, they say, oh, it's happening at last, I'll get a lower price. And then that pullback starts to bounce and they say, oh, am I missing the boat? And they'd rush in and then it gets pushed to another all-time high. So I think the problem we've got, it's not really a problem, it's just a feature, that gold wants to go higher. There's a lot of people who don't have enough of it. They'd like to buy at lower prices. They're waiting for that lower price. And every time we get a couple of percent off, if you're lucky, you get your order in when it's a couple of percent off. But the reason it's going higher at the moment, I think, is just a general uneasiness about holding large cash balances. And that's not just in dollars, it's euros, pounds, yens, whatever you like, maybe not Swiss francs so much. But those who've got large cash balances feel that they're not sure what tomorrow holds. There's a feeling we moved into a more unstable world where the pronouncement from some president somewhere can suddenly change the landscape for your currency. And people are saying, well, we've got in Europe, we've got political crisis in France. UK, it's sort of edging on the edge of a political crisis. USA, there's a huge political crisis. People say, well, what's coming tomorrow? And the feeling is they've got to do something with their money, which isn't cash, because they just don't know what's going to happen down the line.
The Federal Reserve isn't navigating a strategy anymore. It's reacting in desperation. With inflation still lingering and the economy showing signs of contraction, the Fed has quietly pivoted from its tough talk on tightening. Rate cuts have resumed, and behind closed doors, the pressure to restart quantitative easing is mounting fast. But this time, it's different. Unlike previous rounds of QE that were sold as temporary, today's monetary expansion is being forced by structural dysfunction, a $2 trillion budget deficit, collapsing tax revenues, and an unmanageable interest burden that's eating nearly 20% of federal income. October's government shutdown didn't just rattle investors, it exposed how close Washington is to losing control. The bond market is cracking under the weight of endless Treasury issuance, and the only player big enough to absorb that debt is the Fed itself. This is why analysts are warning that the Fed will soon become the permanent buyer of last resort, not just to control yields, but to prevent a total implosion of the U.S. fiscal position. And what happens when the Fed prints to buy its own government's debt? The dollar burns. Smart money sees this, and they're moving into hard assets. Not just gold, but increasingly into silver, where the leverage to monetary debasement is far more explosive. Because in a world where the central bank has lost its anchor, investors aren't waiting for permission. They're front-running the collapse. And this is only the beginning. The groundwork is being laid for a move so radical it would reshape the global monetary system overnight. The signs are everywhere, and the next phase involves gold being revalued to levels no one thought possible.
I think we've got a little bit frothy, but that means we're kind of ripe for a little bit of a pullback. But it doesn't mean to say that the bull market is over. Not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough gold in the portfolio. About a week and a half ago, 2 weeks ago, I attended an investment conference at which many chief investment officers were speaking, from family offices and from some major banks. And I recollect in particular one of the major banks, it happens to be the one I bank with, was speaking, and he was saying, of course, with gold going higher, we've got it in our portfolio, we're recommending it to our clients, and we're using it in our discretionary portfolios. I thought, that's interesting, because my portfolio, discretionary, has got a 0% performance this year. I wonder if there's any gold in it. So I went to have a good look. And there wasn't an ounce of gold in my discretionary portfolio, despite the fact that CIO is standing on the stage telling everybody that they're smart because they put gold into the portfolios. So here's the reality. I think across the board, investment managers would like to say that they're in gold, but a lot of them haven't yet done it, at least not for all their clients. It's one of those things which is work in progress, and they've got to get it done by the year end, because at the end of the year, people are going to be getting their portfolios. They're going to be looking at the portfolio and saying, did you own the asset which beat NVIDIA, which is gold? And they can't not have it. So I think that's the direction of travel from the investment world. The question is, how much are they going to put in the portfolio? Will it be 1%, 2%? I did read one or two banks are saying 5% is the right number. And there was one bank, I think it was Morgan Stanley, even came out and said, now we're 60, 20, 20, with 20 in gold. Now, whether they're really putting 20 in gold or that's just a sort of general comment, I don't know. I mean, it's not possible to put 20% in gold for every investment manager on the planet. There's enough gold out there at any price, so that won't happen. But if every investment manager could get to, say, an average of 2%, and I understand the figures are on average below 1% at the moment, that would push the gold price a long, long way.
For decades, the idea of gold being officially revalued was dismissed as fringe theory, a relic of gold bug fantasies. But with the U.S. debt now surpassing $37 trillion and no political will to reduce spending or raise taxes, what once seemed radical is now entering mainstream conversation. Financial historians and insiders alike are floating one startling solution: reprice gold to $15,000 an ounce to restore balance sheets, backstop confidence, and reboot the system. It sounds extreme, but when you realize that fiat credibility is hanging by a thread, it starts to make a dangerous kind of sense. The math isn't even complicated. To cover liabilities, unfunded promises, and treasury maturities, a dramatic repricing of gold becomes a way to stabilize the dollar without needing to default outright. And if gold is pushed that high, the silver market doesn't just rally, it explodes. Based on historical gold-to-silver ratios, we're talking about silver clearing $500 per ounce in a matter of weeks, not years. That's not a price prediction. It's a structural reality of how leveraged this market has become. And remember, silver is the smaller, tighter, and more volatile cousin of gold. When capital rushes in, the price doesn't just rise, it goes vertical. If this gold revaluation thesis becomes policy, even in part, the silver market could break open in ways most investors simply aren't prepared for. It's not just about upside potential anymore. It's about exposure to a monetary shock that could reset everything we thought we knew about value, wealth, and the role of precious metals in the global economy.
Well, first of all, some parts of the government, including and non-government, including the Federal Reserve, rely on data for all kinds of things. So the Federal Reserve in particular is now flying blind. For example, we didn't get the non-farm payrolls report a couple of days ago because the Bureau of Labor Statistics has shut down. And there'll be a lot more numbers like the inflation numbers, the GDP numbers, all kinds of numbers we're not going to get. So the Federal Reserve is now going to have to make a best guess at what to do. But the whole world doesn't know what's happening. There's probably a whole bunch of numbers that different organizations around the world are relying on. They're not seeing it. And I just think that there's a certain nervousness that if you don't know what's going on, how do you know that your money, if you've got dollars, how do you know what your money is worth, if it's doing anything, and where you stand? So I think, again, it's once again another question of people saying, do I want to have it all in liquid cash, exposed to an environment where at the moment I may not know what's going on. I don't know how long this shutdown is going to last. I mean, people said it would be a couple of days. Well, we're a week into it now. And there's talk that there'll be some agreement done on the healthcare tonight, which might get it over. But from another point of view, if you've got 800,000 people, that's government workers, who are not turning up for work mostly, and the question is not being paid. Now, the mantra is not being paid. I mean, my understanding, and I hope one of your viewers will correct me if I'm wrong, my understanding is when they go back to work, they will get paid, even for the period when they weren't working. But if, as some people are saying, they're not getting paid at all, in other words, they're losing 8 days' pay so far, well, that's a lot of money not going into the economy. A lot of people are going to be struggling to pay bills. And again, it will be another drag on an economy which is already slowing. And we know the economy is slowing because we've seen the job numbers. The job numbers have not been as strong as we've been led to believe by looking at the non-farm pay.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver
The fiat
shipped
system
directly
is quietly
to you.
unraveling,
So get in early,
and the world
stay
is
active.
beginning to notice. This isn't just about the dollar anymore. It's about trust in paper currencies globally. From the euro to the yen, nations are locked in a race to debase, desperately printing to keep their economies afloat and their debts serviceable. But the side effect of this strategy is devastating. Purchasing power is collapsing, and capital is fleeing the system. Investors, institutions, and even governments are moving out of fiat and into real assets: land, commodities, and most critically, precious metals. This is what economists call a crackup boom, a terminal phase where people begin exchanging currency for anything tangible before it loses all value. And silver is uniquely positioned in this chaos. It isn't just a monetary hedge, it's also an industrial necessity. That means it benefits from both sides of the storm: the fear-driven move out of fiat and the growth-driven demand for real-world application. While gold may lead the charge as the traditional safe haven, silver is being pulled by a dual engine that gold can't match. Look at the data. The US dollar index is down, gold is surging, and silver is outperforming both. This is not a rotation, it's a structural shift. Fiat currencies are bleeding credibility, and that shift is accelerating. What we're witnessing is the early stage of a mass exodus, a global migration out of fake money and into tangible stores of value. And once this exodus gains speed, the silver market, with its razor-thin supply and historical volatility, will become the epicenter of the reset.
Payrolls that we have seen, because we know that every month that number gets revised downwards to make the next number look that much better. And we've seen this very, very large writing back of the numbers. I think it was 800,000 or 900,000 jobs, which turned out never to have existed. So the way you could tell that wasn't real, and I said that a couple of times, was by looking at the household survey, because we had the household survey going in one direction and the non-farm payrolls going in the other direction. So one interpretation was that there were more and more jobs, and another interpretation was there's less and less people working. So which is it? I think it was the other way around. There was more and more people working, but less and less hours being worked. So the household survey I thought was the more reliable one, but the one that everybody hung on to was the non-farm payrolls, which is the establishment survey. But we now know, with hindsight, that those numbers were not what they were. Well, we were told. We now know they were much, much worse than expected. So we were consistently going towards an economic slowdown, less people working, unemployment was rising. And I think that does get worse now. I mean, artificial intelligence is not helping. We're seeing quite a few mass firings going on outside of government, and the reason that's happening is in many, many companies, in different departments, you'll have one or two guys who've wised up and got very smart with AI, and now they can do 3 people's work or 10 people's work. And these firms are starting to say, oh, you know what, let's get rid of 2% of our staff or 5% of our staff, and we'll get rid of the ones who are least productive. And the least productive ones are the ones who haven't mastered AI at the moment. So I think that's a slowdown. And of course, the other thing which is going on is big firms are not having much of a graduate intake this year, because whereas a year ago you'd got your graduate in, you say, go and write me a paper on this, that or the other. Now the boss doesn't have to say that anymore. It just says to AI, do it for me. And the AI has done it. So what do you need the graduate for? The AI will do it in a fraction of the time, and it'll be better quality. So slowdown, yes, we're going into a slowdown, I think. But what does that mean? It means that the Federal Reserve will most likely reduce interest rates, and as they reduce interest rates, that it puts the emphasis on employment rather than trying to control inflation, which means that
while the average retail investor is only just waking up to silver's potential, the world's largest institutions are already preparing for a seismic shift. Across family offices, pension funds, and global asset managers, one theme is echoing louder than ever. Precious metals are underowned. Currently, the average institutional portfolio holds less than 1% in gold, and even less in silver. But here's the catch. Even a small reallocation could trigger an avalanche of capital into an asset class that simply doesn't have the capacity to absorb it quietly. Let's put this into perspective. Global assets under management exceed $100 trillion. A move from 1% to just 5% in precious metals would unlock trillions in demand, and the silver market, with its tiny physical footprint, would be the primary beneficiary. Analysts at Bank of America and Morgan Stanley have already begun issuing reports urging clients to reconsider their exposure. The World Gold Council has repeatedly called attention to the strategic advantages of owning hard assets in this environment. Yet portfolio managers remain cautious, slow to act, trapped in a paradigm that no longer fits the reality we're entering. But the tide is turning. With each government shutdown, each rate cut, and each inflation print, the case for silver becomes harder to ignore. And unlike gold, silver's market is far more illiquid, far more explosive. When the institutional money finally moves, and it will, there won't be time to adjust. The repricing will be instant, violent, and irreversible. Silver isn't just underowned, it's dangerously mispriced. And the institutional world is just beginning to realize that it may be the most asymmetrical bet on the table.
the long end of the curve, the bonds which are longer dated, will tend to rise not rise. The yield will rise. The price will fall. The yield will tend to rise to reflect the higher inflationary expectations down the line. So at some point, and I think the market is starting to sense this, we'll get to a point where the interest rates have risen to an unacceptable level. And I don't know what that level would be, but perhaps it's 5 or 5.5%. To put that in perspective, we're around 4.1% now, so it's got a little bit to go. But we could see rising rates of interest at the longer end, at the 10-year or the 30-year end, which gets to a point where the Federal Reserve is invited to be buyer of the last resort. When I say invited, it might be more than an invitation. In other words, it might be an order. So the Federal Reserve, when it gets to the point where it starts to buy these government bonds, where does it get the money from? It electronically prints the money. So this is, when that happens, is the opposite of quantitative tightening. It becomes quantitative easing, and the balance sheet of the Federal Reserve will start to expand. So they print money, that's the liability side, and buy government bonds, that's the asset side. And the reason they buy government bonds is to stop the interest rate from rising, because the government can't sell those bonds to anybody else at that only just acceptable interest rate of, let's say, 5%. Let's say it's 5% is the acceptable, 5.2 is not, for example. So nobody's willing to buy the bonds at a rate of 5% except the Federal Reserve. So they basically put a cap on bond yields, hoping that on the one hand, by lowering the short-term rate, people will be squeezed in the longer run. But at some point, people say, my inflationary expectations for the longer run are actually quite high. They're higher, especially after taxes, than the interest rate I'm earning. I don't really want to own this bond at this price. I'd rather put my money into a house or gold or Bitcoin or commodities or silver, or, it doesn't really matter. But people are thinking, if I buy myself something now, it'll have more value in the future than I'll get by buying a bond and earning 5% and then paying tax on that. So I think the reason gold is rising, they're sensing that this rush of money will come, and we don't know when it's going to come, but I'm going to say could come, probably come in the next year sometime.
Silver's recent rally to nearly $50 an ounce wasn't just impressive, it was a warning shot. What we're seeing isn't the peak of a bull run, but the early phase of something much larger. After surging from around $24 in late 2023, silver's price action through 2024 and 2025 has been described by analysts as frothy, with the relative strength index flashing overbought signals more than once. But every pullback has been met with new waves of buying, a clear sign of underlying demand that refuses to go away. This isn't weak hands gambling on short-term profits. This is strategic accumulation. And here's why that matters. Silver's price chart is sending a message. Technical consolidations are forming a staircase pattern, short, sharp corrections followed by aggressive rebounds. This is classic bull market behavior, driven by a market that wants higher prices but is constrained by short-term resistance and paper suppression. Traders see pullbacks of 5 to 10% not as danger zones, but as buying opportunities, and they're acting accordingly. Volume spikes on dips, premiums on physical don't budge, and retail interest returns stronger every time the price breathes. Meanwhile, momentum indicators are lining up with macro fundamentals. The setup is eerily reminiscent of past silver supercycles, except this time, it's supercharged. There's more capital watching the market. There's more institutional interest. There's more fundamental justification. And perhaps most importantly, there's more chaos in the system. All of this adds up to one thing. The silver market isn't topping. It's coiling. The longer it churns at these levels, the more explosive the breakout will be. And when it happens, history suggests it won't be gradual. It will be sudden, violent, and shocking.
Well, I think, first of all, inflation traditionally was demand pull. So you increase the money supply and you pull up the price of things people needed, like food. But we've moved into a world, at least for the time being, and I'm not going to say this will last, but at least for the time being, in the absence of any major wars or supply chain crisis, we've moved into a world where it's possible to expand the supply to meet increased demand. So even if we all have a lot more money and can then afford to eat twice as many pizzas, twice as many eggs, consume twice as many cows, the prices shouldn't rise too much, because with modern technology, they're able to expand the means of production to meet that extra demand. But what will be inflating, if you inflate the money supply, is when you and I get more money, we're not, realistically speaking, going to consume more of the daily goods. We're not going to watch more hours of Netflix or anything else. And even if we do, it doesn't really matter, because the supply is infinitely expandable. But what we might want to do with that extra money is buy us something which secures our retirement. And we know that the cost of things which are in short supply, like retirement homes, old age care, medical treatment, doctors, a nice country house by the sea, a holiday, a beautiful holiday on a cruise with your spouse and your family, helping your grandchildren to buy their homes. All of these things, the prices are going to be continuing to rise at a faster pace. And the reason they rise at a faster pace is we can see that the amount of government debt is rising. At the moment, it's rising by about 6% a year, but it looks like it's going to go to 7% a year in terms of rising. And so what happens when the government increases its debt? The reason it increases the debt is because it's spending more than it earns in taxes. And this year it'll be about $2 trillion it will spend more than it's earned in taxes. So the debt will go, from this year it's 37 trillion, go to 39 trillion next year. And that's about 7%, 6 or 7% anyway, that range. So as the government gets poorer because it's borrowing money and spending it, someone else out there is getting all that money. And whoever gets it in today's world doesn't say, I'll buy more bread. He says, I'll put it in the stock market, or I'll put it into gold, or I'll put it into houses, or I'll put it into a private equity investment, or I'll put it into something where I know that I can get a proper return on my money, because I'm not getting properly remunerated at the rate of 4 or 5% on a government bond when they're increasing the supply of government bonds by 7% a year. It just doesn't make sense to earn 5 and that there's going to be 7% more of them 10 years a year, every year. And that makes no sense. Why would anyone buy something, get remunerated at 5 when there's going to be 7% more, because you've gone backwards by 2? That's before you paid your taxes. So that's, I think, the way people are starting to think. And therefore, money is cash in the bank where you're earning, 4% if you're lucky. It's looking for other homes.
Something extraordinary is happening in the physical silver market, and almost nobody in the mainstream is talking about it. Silver is vanishing. Not from price charts or ETFs, but from vaults, dealer shelves, and refinery pipelines. What was once a quiet, niche market for coins and bars is now facing an aggressive wave of demand that has begun to expose the system's biggest vulnerability. There simply isn't enough physical silver to meet the appetite of the world's investors. Dealers are reporting weeks-long delays, skyrocketing premiums, and difficulty sourcing even modest volumes of product. Meanwhile, COMEX warehouse inventories are steadily declining, and large bullion banks are increasingly using paper contracts and ETFs as a smokescreen, hoping investors don't start asking for delivery. But those requests are now coming. Family offices, high-net-worth individuals, and even some institutional players are no longer content with paper exposure. They want physical control, and the system cannot handle it. The silver market is structured on the assumption that most investors won't ever take possession. But what happens when too many do? What happens when the float of available metal shrinks while demand accelerates? That's not just a squeeze, it's a structural breach. The disconnection between physical and paper markets is widening every day, and the illusion of price discovery is fracturing under pressure. This is the real catalyst. Not just a chart breakout or a central bank pivot, but a complete breakdown in confidence in the system's ability to deliver real metal. When the crowd realizes that the silver they thought they owned might not actually exist, panic doesn't just set in, it erupts. And in that moment, the price becomes irrelevant. The only thing that will matter is possession.
Well, historically, we've seen periods where one asset class is rising and another one standing still or going backwards. A very good example of that would be from the year 2000 through to 2010, where gold went up several 100% and stocks went down about 12 in that decade. So gold was doing the opposite of stocks. Then we have other decades where other things are doing well, whether it be property or, and I haven't got the periods, but I think everybody's seen this little square chart, which year by year it has the best and worst performing asset classes color coded, and you see every year it seems to change. One year it's bonds, one year it's equities, one year it's gold, next year it's silver, and it varies. But I think we're moving into a situation where you can't really say anymore that one is better than the other, because they're all moving in tandem. All the asset classes are moving on, the tangible asset classes, or the things which are in short supply, because of course some things are not tangible. The things which are in short supply are moving upwards in tandem. And that's something which was described many decades ago, maybe it was 100 years ago, by von Mises. I think he called it the Crackup boom. And the way he described it, he says, to start with, prices are starting to rise, then the price of everything's starting to rise, and then you get to a situation where people start to say they want to protect their savings by owning those things that are rising in price. And then you get to the situation where people actually saying things are rising in price so fast, I don't want to own the currency, and it becomes harder and harder to change your currency into the things that people want to hold on to. So we're a long way from that sort of situation. We're not in a situation today at all where nobody will take your pounds or dollars. Everyone will take your pounds and dollars. But we are getting into a situation where there's a certain amount of those pounds or dollars which don't want to be in pounds and dollars anymore. They want to be in something a little bit more.
Silver isn't just money, it's infrastructure. And right now, the world is building faster than the silver market can keep up. The industrial demand for silver is no longer a supporting factor in the bull case. It's the main engine. Solar energy, electric vehicles, artificial intelligence, 5G networks, data centers, every one of these sectors is exploding in scale, and every one of them requires silver in massive and increasing amounts. Unlike gold, silver is consumed. It's used up, built into components, scattered across devices, and rarely recovered. That means every ounce used for industry is an ounce removed from future supply. The numbers are staggering. Global solar installations are projected to exceed 400 gigawatts this year alone, and each gigawatt requires over 80,000 ounces of silver. Meanwhile, EV production is surging, with silver embedded in batteries, wiring, and inverters. And with governments mandating green energy transitions, this isn't cyclical demand. It's policy-driven, system-wide, and accelerating. AI and 5G infrastructure might seem like digital sectors, but their physical backbone is built on silver. Servers, cooling systems, high-conductivity wiring. Silver is embedded everywhere. And unlike previous tech booms, this one is global. It's not limited to Silicon Valley or Shanghai. It's happening in every continent, every market, at once. The result? 4 straight years of structural silver deficits, as reported by the Silver Institute, with 2025 projected to be the worst yet. The industrial machine isn't slowing down. It's growing more demanding, more global, and more inescapable. And as this consumption accelerates, it quietly tightens the noose on silver supply. Investors often focus on monetary catalysts, but the real powder keg might be industrial. Because when silver is needed not just for wealth preservation, but for powering the planet, the stakes and the price are only going one way.
First of all, I'll say they cannot afford not to do it. So it's going to happen, in my opinion. The real question which is out there is, well, 3 questions really. One is, will it happen? And I've answered that one. I think they cannot afford not to. The second question is, when will it happen? And the third question is, at what price? Now, there's been a lot of numbers bandied around about the right price, and I postulated that it might be $15,000, which I felt was the right level to, one, cover this year's deficit, a bit of next year's deficit, and pay off the maturing bonds in the next 12 months. So they could have a year or two of grace where the government debt actually goes backwards instead of forwards, because there'll be, as bonds mature, there'll be repaying them instead and not having to borrow. And as far as the current deficit is concerned, based on my $15,000 level, at least for a year and a bit, they would be able to pay all the bills without running, or all the excess bills above what they're collecting taxes, without running into deficit territory. So the debt of the government would be, for a year or so, maybe a year and a half, 2 years, be going backwards. And it would give a little bit of breathing space to work out what they'll do going forwards. Because obviously the debt cannot continue increasing ad infinitum, because, it can increase ad infinitum, provided it doesn't increase faster than the economy. But unfortunately, it's increasing much faster than the economy. The economy is growing by 1 or 2 or 3%, and the debt is increasing by 6 or 7%. So that can't continue. It's like you have a credit card. You might get a higher salary, but if your debt on your credit card is increasing by 10% a year, but your salary is only going up by 5% a year, you're actually going backwards. And in the end, you're effectively bankrupt, because you get to a point where the interest you're paying to the credit card company exceeds everything you earn. And that's the situation and the direction of travel that the government's in. And it's not just me saying it, it's the Bureau of Labour Statistics themselves who say the same thing. So 2 or 3 years ago, about 8% of government receipts went into paying the interest on the national debt. This year, it'll be 18%. So we go from 8 to 18% of the interest paying, of the tax collected going and paying debts. And the Bureau of Labour Statistics, if you read their official budget, which was brought out last January, so it's very, very old, and it's got worse since then. But when they brought out in January, they postulated that they predicted it. If you look at their own numbers and crunch them, you'll find that they're going to, in a couple of years, 22% of GDP. And that's based on an assumed interest rate that the government will be paying, which is significantly lower than the lowest rate they can get at.
The real problem isn't just demand. It's that the silver supply can't respond. For years, the mining industry has been operating on razor-thin margins, with little incentive to expand production. Now, just as the world wakes up to silver's critical role in both monetary and industrial systems, the supply side is hitting a wall. Global mine output has remained flat despite higher prices, and the reasons run deeper than temporary disruptions or weather-related slowdowns. This is structural. New silver projects are scarce. The permitting process has become more restrictive. Environmental regulations are tightening, and large-scale discoveries are virtually non-existent. Many of the world's most prolific silver mines are aging, with declining ore grades and rising extraction costs. Even major producers are quietly shifting focus to more profitable metals, leaving silver as a byproduct rather than a priority. In other words, even if demand doubles, the supply can't. Not without years of capital, exploration, and geopolitical stability that simply doesn't exist right now. On top of that, rising energy prices and labor shortages are inflating operational costs across the mining sector. And let's not forget, most silver comes from politically volatile regions like Peru, Mexico, and parts of Africa. Any disruption, whether from strikes, policy shifts, or social unrest, sends shockwaves through global supply chains. The market assumes that higher prices will magically create more silver. But what if they don't? What if we're already at the limit of what can be mined without major investment that the industry isn't making? That's what makes this moment so dangerous. The world is charging into a high-tech, green-powered future that runs on silver, but the supply machine is stuck in neutral. And when reality hits, the price won't just rise. It will have to reprice the entire supply chain.
At the moment, because the lowest rate the government can borrow at the moment is something like 4%. But the assumption is that interest rates are going to be knocking around 3% for all maturities. That's the Bureau of Labour. So they've underestimated the number. But even with that underestimated number, that debt is going to go to 22% in a couple of years the interest they're paying is going to go to 22% of what the government collects in taxes. Now, if you project that forward ad infinitum, you get to a point where the interest payments become a larger and larger share of the taxes being collected. The question is, at what point do investors say, I'm on a hiding to nothing. I'm not going to be repaid in anything which is worth something, because this is just spiraling out of control. If it was your best friend, you unless you wouldn't lend him money. You might give him the money because you feel nice to him, but you wouldn't believe that if he had a credit card debt of that size, that you've got any chance of ever being repaid. Now, people say, I will be repaid because the government can effectively print money ad infinitum. They can tax the population ad infinitum if they have to. They could charge people, everyone, 100% of what they earn and hopefully get it back. So people still believe that they're going to get it back from the government. But the reality is, if you do get it back, you're going to get it back in heavily devalued dollars 10 or 20 or 30 years from now, and it will not buy you the kind of things in retirement that you could buy with the same amount of money today. It's going to buy you an awful lot less. So I think it depends on where you are in life. If you're living hand to mouth, these things don't really affect you because it comes in one end and goes out the other end, and if prices go up, your salary will probably go up with it. But if you happen to be a wealth accumulator, you're now in a battle to say, what can I do to preserve my wealth? Because otherwise I will be going backwards, especially if I've got $1 million in government bonds or Apple bonds or anything else like that.
Beneath the surface of the silver market lies a hidden risk that could detonate without warning: the derivatives time bomb. For years, the paper silver market has masked the true state of supply and demand. Futures contracts, ETFs, and synthetic instruments have created the illusion of abundant silver, but the numbers tell a different story. For every ounce of physical silver that exists, there are dozens, if not hundreds, of claims on that metal. This isn't speculation, it's documented fact. And the moment too many holders ask for delivery at once, the system breaks. COMEX, the central arena for silver futures trading, is built on fractional reserve principles. Traders roll contracts, institutions settle in cash, and actual delivery is rare. But what happens if confidence fades? What if, amid rising distrust in fiat and financial institutions, investors begin demanding the real thing? We've seen early signs already: spikes in registered silver withdrawals, bullion bank stress, and ETF outflows. If these pressures accelerate, a full-blown short squeeze could erupt, not on a Reddit forum, but at the institutional level. Even more dangerous is the interconnectedness of these paper positions. Bullion banks have hedged and re-hedged their exposure through complex webs of swaps, options, and off-balance sheet instruments. A breakdown in one corner of this web could trigger a cascading default. This isn't theory. It's the same kind of systemic fragility we saw in 2008, only this time the trigger isn't mortgage debt. It's the failure to deliver metal. And the scary part? The regulators aren't prepared. The exchanges aren't prepared. And the public has no idea what's coming. The silver market is small, too small to absorb a panic. When the derivative illusion collapses, the rush to physical won't be measured in dollars, but in hours. And when that happens, silver won't just spike. It'll decouple entirely from the financial system that once tried to control it.
These speculators, these wicked speculators, speculating against our currency, we've got to put a stop to it. So we'll temporarily close the gold window so that these wicked speculators, meaning foreign central banks who happen to hold a lot of dollars, couldn't change their dollars into gold anymore. And from that day on, the United States, it didn't happen immediately, but slowly, but after a few years, they started to realize, well, it doesn't matter if we borrow more and more. It doesn't matter if we spend more and more, because nobody's going to come asking for their gold back, because they can't. They're not allowed to. So the gold price was floating freely. And of course, the more that the government got into debt, and it got into more and more debt year after year. Back then, the debt of the US government was in the billions. I don't know what it was. Now it's in the trillions, 1,000 times as much. But the more and more they got into debt, the more and more money was in the hands of other people. And as more and more money got in the hands of other people, some of them said, I'll put some of that in gold, thank you very much. Of course, it benefited house prices, it benefited the stock market, and it benefited wages and salaries and everything else on the planet. Kept in a way, I'm not saying it's wrong, but it certainly kept the economy in a almost perpetual boom. I mean, since I started work in 1975, I guess I've only seen 4, 5, 6 large stock market declines or crashes, if you like. Maybe some of them were crashes, some of them were declines in 50 years. doesn't seem a lot to me. But every time there's a crash, well, you never, broadly speaking, you never had time to buy. So the best thing to do in a crash was do nothing, and the market would go down, then a year later it would be back up, and it'd be another all-time high. I mean, I've seen hundreds, possibly thousands of all-time highs. I've never yet seen an all-time low.
Silver is no longer just a commodity. It's the pressure valve of a collapsing system. Every force we've discussed, the Fed's monetary retreat, the government's fiscal chaos, the global rejection of fiat, the institutional awakening, the industrial explosion, the physical shortage, and the fragile supply chain, all converge into one singular truth. Silver sits at the intersection of everything that's breaking. And that makes it the most asymmetric asset on the planet. This is what few understand. Gold may anchor the monetary reset, but silver is where the volatility and the real gains will happen. Its dual identity as both a monetary metal and industrial necessity gives it a unique role in this moment. When gold is revalued, silver will chase, but it won't just follow passively. It will overreact, just as it has in every past supercycle. It will amplify the moves, exaggerate the volatility, and deliver returns that seem implausible until they happen. But this time is different in one crucial way. The underlying system itself is breaking. Not temporarily, not cyclically, but structurally. The trust in central banks, in government bonds, in fiat currencies, in the very idea of deferred wealth, it's eroding fast. And in that environment, silver becomes more than just an asset. It becomes a life raft, a store of energy, a rebellion against a broken status quo. And the beauty of it? The market still doesn't see it coming. Silver is still dismissed, underowned, and mispriced. That's what makes it explosive. Because once it moves, it won't be a steady climb. It will be a violent repricing as decades of suppression, denial, and complacency are burned away in a matter of weeks. The moment of ignition is coming. And when it hits, silver will not just rise, it will roar.
There will come a point, in all probability, and I don't know the number of years or minutes, we don't know, it could be very quick, it could take years, but there will come a point where there is some sort of crisis, and it won't be a crisis, it won't be one of the crises which are predicted. Almost every stock market crash or big decline has come from a reason which was not in the predictions. Every year, there's lots of predictions as to why things are going to go south here. War, recession, higher interest rates, falling dollar. It doesn't matter. There's always COVID. It doesn't matter. There's always a reason. But when that recession happens, when that crisis happens, it always comes from something that nobody saw coming. So there will be, and there always has been, at some point, a crisis, and we don't know what it's going to affect, but if it affects confidence in the currency, for example, it could be a very severe recession where the taxes are not being collected because people aren't working enough, and therefore they have to print a lot, and then the inflation gets out of control, or people perceive the monetary expansion gets out of control, and then they lose faith in the currency. Then emergency action is called for, and we don't know what that emergency action will be. I've got a pretty good idea what it'll be, but I do know from history, and throughout history, this has happened over and over again, where countries have become over-indebted, then they've faced a crisis, and then they've had to take some drastic action. In general, the next thing which happens is a new currency in some way, shape, or form. But there might be emergency actions as we go through, like confiscation, bail-ins, where they help themselves to the money in the bank. We just don't know. But if you want to get to the other side of it, you need to have some things that they can't take off you, or which are hard to take off you. Because if you have assets in the bank, especially if it's cash, it's like a sitting duck. If you have government bonds, they're in control, not you. You are owed money by somebody who can't pay. So what do you think? Do you think they'll pay you? In some way, shape, or form, you're not going to get what you thought you were going to get. Whereas if you happen to have something which they can't easily take off you, whether that be real estate or gold or something else that's in your physical possession, it could be bottles of whiskey, it doesn't really matter. And you might take the view they can't take my Nvidia shares off me. That's another view, because it's a lot harder to take someone's Nvidia shares than it is to take their bank account balance. But it doesn't matter. What I'm saying is, to get to the other side, you need to own things which they can't take off you. And some of those things should be in your personal physical possession, where only you can get your hands on them. And of course, given that you're a fan of gold, that we know what that means for you. Can I just say that I did put out a video a couple of days ago about how to make a lot of money, almost like a free lunch, using a special technique and a special type of company which is quoted on the stock market. So anybody who wants to get into the stock market and wants to have a technique to make money, it's not guaranteed, not risk-free, but it's as near to risk-free as you can get. Have a look at my video. It's Clive Thompson on YouTube.
We are standing at the edge of the greatest financial reset in modern history, and silver is the spark that could light the fuse. Every pillar holding up the current system, fiat stability, monetary policy, trust in institutions, is cracking. The Fed is trapped, debt is unpayable, and faith in paper promises is dissolving before our eyes. In response, capital is stampeding into hard assets, and silver, with its unique blend of scarcity, utility, and volatility, is set to lead the charge. This isn't about chasing gains. It's about surviving what comes next. A gold revaluation to $15,000 would confirm everything the monetary establishment has denied for decades. And when that happens, silver will no longer be an option. It will be a necessity. The physical shortage, the derivative distortion, the industrial black hole, it's all converging into a perfect storm. One that reprices not just silver, but the global financial order. If you've made it this far, you're ahead of the curve. But the window is closing fast. When silver breaks out, really breaks out, the mainstream won't give you a second chance. So stay alert, stay informed, and prepare accordingly. The financial world is being rewritten in real time, and those holding silver won't just survive it, they'll define it. Don't forget to subscribe if you want to stay ahead of the curve, and as always, this is not financial advice. Please speak to a licensed professional before making any investment decisions.